What if every 1 hour candle gave you a trading opportunity? This is a simple strategy made for trading gold. You don't trade every candle, just pick one per session. Asia, London, and New York. Each wick shows manipulation, and after that comes a strong expansion. That's where the edge is. Now, before we go any further, I need to make something very clear. If you're someone who thinks this strategy has a 100% win rate, or even a 95% win rate, then this video probably isn't for you. I'm not here to sell you a fake dream, and I'm not here to create unrealistic expectations. What I'm teaching you here is a real gold trading strategy. It's practical, it's repeatable, and it's based on execution and discipline, not guarantees. Now, yes, by using this strategy, you can find trading opportunities in almost every 1 hour candle. Technically, you could take trades on each of those candles, but that's not what I recommend. Just because an opportunity exists doesn't mean you should take it. Instead, you need to be selective. You should limit yourself to one candle per session. That could be one trade from the Asia session, one trade from the London session, and one trade from the New York session. That's it. 3 trades maximum per day. This approach keeps you disciplined, helps you avoid overtrading, and forces you to focus on the best setups. Consistency in trading doesn't come from taking more trades. It comes from taking better trades. Now, you need to understand that every candle you see on the chart has a wick, either to the downside or to the upside. You'll notice it over and over again. Downside wick, upside wick, downside wick, upside wick. These wicks are what I usually refer to as manipulation. Why do I call it manipulation? Because after the wick is formed, price usually moves back in the opposite direction and closes somewhere around the body. In simple terms, this is what we call accumulation, manipulation, and distribution. Accumulation is the phase where price is consolidating. Manipulation is when price sweeps liquidity, usually through the wick. And distribution is when price delivers in the intended direction, either to the upside or the downside. Keeping that in mind, you can actually use every single 1 hour candle. So now let's get into the strategy and I'll explain how this works in practice. This strategy works well on gold and NQ. You can take up to 3 trades per day by using the 1 hour candle power of 3. So let's focus on this 1 hour candle here. You can see that this candle has a wick to the downside and then a body that closes higher. That tells us price went down first and then closed back up, which makes this a bullish candle. The goal here is to get an entry somewhere during that lower portion of the move so we can take advantage of the entire move to the upside. The strategy itself is very simple. As soon as a new 1 hour candle opens, the first thing you want to do is mark out the opening price. This opening price is just a reference point for us. Once you have the opening price marked, you want to look to the left side of that open. After that, you drop down to the 5-minute time frame. On the 5-minute chart, you're looking to mark the closest 5-minute high and the closest 5-minute low that formed before the 1 hour candle opened. These are the most recent highs and lows to the left of the open. So now you have 3 things marked: the 1 hour open, the 5-minute high, and the 5-minute low. After the candle opens, you're simply waiting for price to sweep either the 5-minute high or the 5-minute low. In this example, price sweeps the 5-minute low. You'll notice price moves around a bit, goes up and down, and then eventually takes that 5-minute low. Once that happens, you drop down another time frame to the 1-minute chart. So the flow is 1 hour to 5-minute to 1 minute. On the 1-minute time frame, you want to see price clearly sweep that 5-minute low. After the sweep, you wait for a market structure shift on the 1-minute chart. Once that structure shift forms, you can look for your entry on a retest, whether that's a breaker block, an order block, or a fair value gap. From there, you target standard deviation projections and manage the trade according to your plan. That's the full idea behind this setup. You're using the 1 hour candle for direction, the 5-minute chart for the liquidity sweep, and the 1-minute chart for precise execution. Now let's talk about standard deviation projections, because this is an extra confluence that I personally use in my trading. The very first thing you need to wait for is a liquidity sweep. Nothing happens before that. There is no shortcut here. Once liquidity is taken, that's when we start paying attention. So let's say this right here is the liquidity sweep. Price comes in, takes out the liquidity, and now our job is to wait and see what happens after the sweep, not before it. After the liquidity sweep, you want to identify the most recent market structure shift that forms. This is very important. The structure shift must happen after the sweep. So once liquidity is taken, look to the right. Here, you can clearly see a market structure shift. And what does a clean market structure shift look like? You'll see a higher high, then a higher low, then another higher high, and finally a break of that higher low. That break confirms the shift in structure. Now, once you see that market structure shift, it tells you something very important. It tells you that the manipulation phase is likely over. Remember, price moves in 3 phases: accumulation, manipulation, and distribution. Accumulation is when price is consolidating, manipulation is when price is sweeping liquidity, and distribution is when price starts delivering the actual move. So now the question becomes, how do we measure that manipulation phase and get an idea of where distribution is likely to end? This is where the Fibonacci tool comes in. What you want to do is take your Fibonacci tool and draw it from the last high that was formed to the last low that was formed during the manipulation phase. Once you draw it correctly, you'll start to see projected levels below price. These projections are your standard deviation levels. From my experience, the manipulation phase usually completes, and distribution often starts to slow down around the -2 to -2.5 levels. That's why I pay close attention to those areas. Now, this is an extra confluence. You don't have to use this if you don't want to. The strategy still works without it. But if you want more precision, especially for targets and exits, this adds a lot of value. So the process is very simple and repeatable. First, wait for the liquidity sweep. Second, wait for a clear market structure shift after the sweep. Third, use your Fibonacci standard deviation projections with the correct settings. When price reaches the -2.5 level, that's usually where distribution is close to ending. And the same exact concept applies in reverse when you're looking at short trades. I'm going to show you some examples next, and once you see this applied on the charts, everything will become much clearer. All right, guys, so this is example number 1. We're looking at gold on the 1-hour time frame, and we're going to focus specifically on the 6 a.m. candle. So this right here is the 6 a.m. 1-hour candle, and it has just opened. The very first thing we're going to do is mark the open of the 1-hour candle. That opening price is important because everything we do next is going to be built around it. Once the 1-hour candle is forming and the open is marked, we immediately drop down to the 5-minute time frame. On the 5-minute chart, we now look to the left side of the 1-hour open. If you look closely, you can clearly see these highs over here, and you'll notice that they're very close to each other. These are equal highs, so we mark that high out. At the same time, we can also see a clear low on the left side. So now we have a high and a low marked from the 5-minute chart, both formed before the 1-hour candle opened. At this point, we're simply waiting. We're waiting for price to either sweep the high or sweep the low. In this example, price ends up sweeping the high. Once that liquidity sweep happens, that's our cue. After the sweep, we drop down to the 1-minute time frame. On the 1-minute chart, all we're looking for now is a market structure shift. And in this case, we get a very clean structure shift. Price breaks this low, which confirms the shift in structure. Along with that, we also have a fair value gap that we could use for entry. You could either enter using that fair value gap, or you could enter directly at the structure shift itself. In this specific example, we don't have a clean market structure shift leg close. So instead, we use the leg before the structure shift, but after the liquidity sweep for our standard deviation measurement. Using that leg, we apply our standard deviation projections and target between the -2 and -2.5 levels, which lines up nicely with this low right here. And as you can see, price moves very cleanly and very easily into the targets. This is a textbook example of how the whole process comes together step by step. All right, guys, this is example number 2, and this time we're looking at the 5 a.m. 1-hour candle on the same day. Like I mentioned earlier in the video, you can actually utilize every single 1-hour candle if the conditions line up correctly. So just like before, the first thing we're going to do is mark out the opening price of the 1-hour candle. That opening price is always our starting reference. Once the candle opens and the open is marked, we want to observe how price behaves within that 1-hour window. After marking the open, we immediately drop down to the 5-minute time frame. Now that we're on the 5-minute chart, we look to the left side of the 1-hour open. This part is very important. We're looking to identify the most recent unswept highs and unswept lows that were formed before the 1-hour candle opened. In this case, you can clearly see an unswept low right here. And if you look a bit above price, you can also see an unswept high right here. So now we've marked out both sides of liquidity, the high and the low, that price could potentially target. At this point, we don't do anything. We simply wait. We let price decide which side of liquidity it wants to take. In this example, price ends up sweeping the high once again. Once that high is taken, that tells us liquidity has been grabbed from that side of the market. As soon as the liquidity sweep happens, we move to the next step and drop down to the 1-minute time frame. On the 1-minute chart, ideally, we would want to see a clean market structure shift to confirm entry. However, in this specific example, we don't get a very clear or obvious structure shift on the 1 minute. And that's completely fine. When we don't get a clean market structure shift, we don't force it. Instead, we look for other valid entry PD arrays that align with the setup. In this case, we have an inverse fair value gap, which can be used as an entry model. We also have a volume imbalance, which can be used as an alternative entry model. Either one of these works, as long as it aligns with the liquidity sweep that just happened. So we take our entry from one of those PD arrays, manage risk properly, and then for targets we simply aim for the opposing sell-side liquidity. And as you can see, price delivers very cleanly into those targets. This example shows that even when you don't get the perfect market structure shift, the strategy is still very effective as long as you follow the process, stay patient, and let liquidity guide your decisions. That's what makes this strategy simple and repeatable. All right, guys, that's going to wrap up this video. By now, you should have a clear understanding of how this strategy actually works from start to finish. You're using the 1-hour candle for direction, the 5-minute chart to identify liquidity, and the 1-minute chart for precise execution. You're not guessing, and you're not forcing trades. You're letting liquidity and structure guide you. Remember, this strategy is not about win rates or taking every single setup. It's about patience, discipline, and consistency. If you focus on one candle per session, wait for clean liquidity sweeps, and only enter when price confirms, the results will take care of themselves over time. If this video helped you out, make sure to like the video. It really helps support the channel. If you want more ICT-based strategies and real trading breakdowns like this, go ahead and subscribe. If you want to connect with me, you can join my Telegram and Discord. The links are in the description. If you want to learn personally from me, you can also check out the mentorship link in the description. And if you're interested in funded accounts, I've left discount codes in the description as well. Trade safe, manage your risk, and I'll see you guys in the next one.